Hello everyone, welcome to today's US Open live webinar. I am your host Nikos Tsabouras, Senior Financial Editorial Writer at FXCM. It is Thursday, September 21st, 10 minutes before Wall Street opens as always, and central banks dominate this week as the Fed delivered a hawkish hold on Wednesday night, boosting the US dollar and sending Wall Street lower, while the Bank of England today picked up the baton with a surprise pause after 14 straight hikes, which harms the British pound. Focus now shifts to the Bank of Japan, which announces its policy decision on Friday. That is what we will be covering in today's session, but first, please read carefully through the risk warnings and the disclaimers. Once again, before we begin, please read carefully through the risk warnings and the disclaimers, and bear in mind that anything discussed here does not constitute investment advice and should not be construed as such. Let's give you a few more seconds to do that, and then we will get started. Okay, let's get the ball rolling. We're gonna start a bit differently today. We're gonna begin with the Nasdaq and what the Fed decided, then move over to Euro USD and its impact there, then talk about today's decision by the Bank of England and how GBP USD reacts, and then round our session off with tomorrow's decision by the Bank of Japan and what's the backdrop there. So the Fed kept rates unchanged unanimously at 5.5% on Wednesday in what was a hawkish hold, since its updated projections confirmed the higher for longer prospects. Participants maintained the 5.6% median rate projection for this year, which implies another hike before they reach terminal rate. And that was where the surprise, let's say, came. They lowered the median projection for 2024 to 5.1%, showing a tougher stance ahead and fewer cuts than previously thought. The bank also embraced the soft landing scenario, since participants raised the GDP growth forecast for this year, 2024 and 2025, and also lowered the unemployment projections for these years as well. PC inflation is seen hitting 2% in 2025, both core and headline. Of course, you can read more about the Fed's decision on the FXCM market analysis websites of your respective regions for the Fed and the Bank of England that we're going to talk about later on. So now on the NAS 100, which we have on our screen, of course, the index slumped on the outcome of the Fed and now threatens critical support levels, which are provided by the ascending trend line from this year's lows. And the August lows follow. You can see here at this region a little over in the mid 14,700s up to 14,555. A breach would expose the index to the 200 days exponential moving average, the blue line that you see a little above the 14K mark. However, the Fed may have already done enough, while various other factors such as worker strikes, expectation for a restart of student loan payments could help contain inflation and make the Fed's lives a little bit easier, and potentially give it a more relaxed stance, let's say, than the one projected. Furthermore, the relative strength index, which you can see at the bottom of the chart, reaches the most oversold levels of the year. As such, we can see a recovery effort, and reclaiming the 200-period EMA, the black line on the chart, would shift bias back to the upside, but the 2023 high looks distant at this point. The 200-period EMA is located around 15,250, and we also see around this region the daily smoke cloud, and of course the 2023 highs are at 15,946. Okay, so that's it for the Nasdaq. Now let's talk about Euro USD. So we already discussed about what the Fed decided. That of course boosted the US dollar and harmed Euro USD because it was a hawkish hold, as we said. And you can see here yesterday that the pair dropped, and a week earlier the pair had dropped again after the European Central Bank, which was in opposite directions of the Fed, since it delivered a dovish hike. So hawkish pause by the Fed, dovish hike by its European counterpart. Now the ECB last week, as we've already talked about, raised rates for 10th straight time, but hinted at peak rates. Now the Euro's previous rate advantage has been eroding for a while, and now there is a reversal in the outlook differential, since, as we said, the ECB hinted at a peak, while the Fed pointed towards more hike and a higher for longer environment. The Euro USD is in a perilous state, threatening the 38% Fibonacci. We've talked about it again, of the 2022 low, 2023 high rise. That could open the door for new 2023 lows, which are located at 1.04816. The downside bias is clear, but we don't necessarily expect any fireworks here. European policymakers may have a hard time staying on the sideline, as we've talked about before, because inflation remains far from the 2% target. On the other hand, the Fed may have already done enough, given inflation moderation, massive amount of tightening, and of course the lagging nature of the transmission mechanism. The pair already tries to find some reprieve and defend the 38.2% Fibonacci. Successful effort will give it a chance to rebound towards the resistance confluence at around 1.078, 1.08, but does not inspire confidence on this stage for a break above those levels. That would, of course, pose the downside bias that we talked about. And now let's talk about GBP USD. You can see here on the daily chart the immediate reaction after the Bank of England, which was lower. And why was that? Because the Bank of England hit the pause button earlier today, keeping rates at 5.25% after 14 consecutive hikes since the December 2021 liftoff in a watershed decision. Of course, it was emboldened by Wednesday's soft inflation reports. Headline CPI ticked down to 6.7% in August, and that was a smaller increase in over a year, while core CPI decelerated markedly to 6.2% year over year. Officials, we've talked about this again, are in a bit of a bind. They have to grapple with economic slowdown and raising mortgage costs. However, keeping rates at this level over next meetings may prove hard. Today's decision was 4-5 split with 4 members descending in favor of another hike. Inflation is not expected to fall to 2%, the 2% target for another couple of years, and wage growth remains at historical highs. The bank, of course, did not offer forward guidance, sustaining the uncertainty around the policy outlook. In any case, GBP immediate reaction was lower. Of course, it had dropped yesterday as well after the Fed. This makes it vulnerable to 1.278, which is a 38.2% FIBO of the 2022 low, 2023 high. But the move looks stretched from a technical perspective, while from a fundamental standpoint, it may also be a little bit exaggerated, as we're sort of in the thick of it right now. We will need to see how things are when sentiment settles down a little bit. In any case, we could see recovery effort, but the upside looks unfriendly, especially from around 1.25 onwards. We have the 200 days exponential moving average and the 400 period exponent, and then 200 period, 208 force, since we're on the 4-hour chart, exponential moving average a little above. Now, let's talk about what's ahead, and that is Japanese inflation and the Bank of Japan on Friday. Now, inflation ex-food and energy is off its peak, was at 3.3% in the last print, remains above the 2% target for more than a year, despite being off its peaks. Every print is critical since the central bank believes that sustainable and stable achievement of the 2% target has not yet come in sight. Based on this, it has been implementing an ultra loose policy setting, in contrast, of course, with its major counterparts, and to the detriment of the yen. We've talked extensively about the yen's problems, especially, of course, against the US dollar. In the last meeting in July, the Bank of Japan made the yield curve control more flexible, keeping the 0.5% plus or minus target, but now offering to purchase 10-year JGBs at 1%. That was a step towards normalization on the one hand, but also a change that allows it to sustain this super accommodative stance. Now, Governor Ueda had generally not shown much inclination to change the status quo, but in a recent interview, he opened the door to an eventual exit from negative rates, which marks a turning point, at least in terms of rhetoric, and sets an interesting backdrop for this meeting. It doesn't seem easy for any changes now at Friday's meeting, but he didn't signal any imminent shift. But there's an interesting backdrop, and it will be important to see what the Fed decides around the yield curve and around rates, of course, and how it uses inflation, and if there has been a change there. And that will be the main event of Friday. We also have preliminary PMIs from UK, EU, and Germany, from various regions. Actually, these have been quite poor from these 3 regions, and the US, which have been better overall. Next week starts in a slow mode, but things heat up towards the end. That's it from me. Thank you for joining me. We will talk again next week on Tuesday at our usual time slot, 10 minutes before Wall Street opens. Thank you for joining me.